You're listening to The Real Estate Ride. Make sure to subscribe and enjoy the show.
Why would he go and pay off all these debts? So once you pay off those debts, your scores may drop significantly initially, and they'll let them come back organically with your responsible use of credit. So that's why Fannie and Freddie have fought vehemently to keep this model, because all the newer models, once you pay that stuff off, it looks like it's never been there before. So they have to change their whole underwriting guidelines, their whole book, because then it won't be based on score. It'll be based on the accounts that are still posting on the accounts. So it may be paid collections have to season for 12 months, something like that, if they do adopt a new score. So it's a huge deal for them.
Thanks for jumping on. This morning we have a special treat. I've been trying to link up with Chad for a little while. Like an amazing company. And the company's focus is credit consulting and credit repair. So Chad and I, we linked up quite a few years ago. I think probably within 6-7 years.
Yeah, I would imagine. Well, we're going to be 12 years in March. I've been doing this.
Yeah, 12 years in March. So when I was working with buyers a lot, and I got linked up back in the day when credit had tightened up, and we could go over that some too. Like when I started doing loans, somebody had a 550. Oh boy, they could get a loan. Somebody's kind of loud. If you could mute your microphone. So when I first got started, you could get an FHA loan with a 550 credit score, and then the market crashed, and then it went up to 580, 600, and then the standard even became 620. So it went from, it was a 70-point jump for you to be able to get a loan. And you're going to see that again when the importance of credit is it's a high level of importance, and even the same for higher end credit clients. If you're looking to get a home equity line of credit on your house right now, you could probably get one if you have a 650 credit score. And I'm guessing because we don't do loans anymore, but when the market crashed, it quickly went up to 700, 720. So it's very important that we understand credit, and we're focusing on it, and we're trying to build it up as high as we can. But I just wanted to introduce Chad and let you know that he's helped a number of our clients that were buyers, and I've seen some of them get their credit scores raised 100 points within a 4-month time frame, which to me is phenomenal. So, Chad, why don't you tell us a little bit about yourself? Like, how did you get started in this business, and where's your company based now? And just give us a little background, if you would.
So I, my first life, I was self-employed with my father. So I basically been self-employed my whole life. And around 2000, was getting married and wanted a career change. Couldn't work things out with my dad, so I got into the mortgage industry during the boom. Right, I mean, it was high time in 2001, and really was enjoying what I was doing. And around 2005, I went to go buy the house that I still live in today. It was my second home, but when I pulled my credit, I was like a 573, and I had no idea, because my first house, back when I got my first loan, was an FHA loan, and literally you did not need a credit score. So it didn't matter that I was in the low fives. At that time, it was all about the underwriting, and it was, if they call it loosey goose, however you want to term it, my friend got me financed and bought my first house in South Euclid and was there for 5 years. So when I went to go get financed to move to Solon, I had no loan product that was even favorable, even though I could have done 100% financing with that score at the time. I knew what I wanted. I wanted a paper loan to get the best financing possible. So everybody in my office said, Chad, whatever you do, don't use a credit repair company. All they're doing is a bunch of snake oil salesmen. They'll take your money. They write dispute letters. Do it on your own. It's not rocket science. But at the same time, it was 2005. So it was the high time. I mean, I was taking in application after application. And when I was taking time to look up, dispute letters and what do I ask? Who do I ask? How do I ask it? I got frustrated because I needed to focus on my job. So I got referred to an attorney out of Cincinnati, and I thank him every day. His name's Eddie Garrett, and he still does it today, but he does it still on a very low level. But he did an awesome job, and he was a consumer protections litigator. So he knew what to ask the bureaus, how to get things removed off the credit report, and what they would probably not be able to respond to. But his follow-up was horrible. When I called him in 60 days, I said, Eddie, how is my credit? He goes, I'm not a loan officer. I have no idea. Pull it. Tell me what it looks like. And I was like, that's customer service, for you. Anyways, I pulled it on freecreditreport.com, right? And that was at the time the jingle, right? Everybody remembers the original one. Uh-huh. I was a 770. And I was like, pardon my French, holy shit, this guy's a miracle worker. I can't believe it. I ran back to my desk again after I printed the report and pulled my RMCR, my residential mortgage credit report. And I was 676. So I needed 680. I was 4 points away, but I was pissed. I'm like, why is it telling me I'm a 770? I just pulled a 670. Yeah. And I proceeded to call freecreditreport.com to get an answer from them. It was about an hour and 45 minutes on that call for they finally came back and said, oh, we're sorry, Mr. Kusner. We use a different scoring model than you use as a mortgage lender. That's why your scores are different. So I immediately was like, that's not fair. You're not letting consumers know this. And when you log into any of these, to this day, these consumer sites, there's always a lead click, right? Click here for a mortgage, insurance quotes. Even when you log in, they'll ask you what you're logging in for, right? Are you looking to buy a house? Are you looking to get a car? Are you looking for student loans so that they can market to you and make more money off your lead buys? Right. Yeah. So I went home and I told my wife, I said, listen, I think I can do this. I think if we can create a good conduit between myself as the credit repair company, loan officers and realtors and buyers, I think that we can have something. So instead of hitting me with a brick, she says, great idea. I'm going to introduce you to my boss. So her boss has been my partner now for 12 years. His name's Bob Willis, and he's been a consumer litigator himself for 25 years. So his focus has been Fair Credit Reporting Act law, fair debt collection, statute of frauds, lemon law. Anything that is focused on helping the consumer is what he's done. So we met, we gelled very well, and we started beta testing in 2005. By 2007, we saw that it was beginning, we were making progress. We then got our licensing, our bonding, our E&O insurance, and started to work on this. By 2010, I had stopped originating full-time, and I've been doing this ever since. And the core business we get is report-based. So we do get our organic traffic from Google and from the social media that we are on, but I really look for referrals because I want people that are serious about fixing their credit for a few reasons. One is they're the ones that I'm actually helping and that I'm not taking money from and just rearranging the deck chairs in the Titanic, right? Two, they convert much easier. So when you say, listen, go talk to Chad, don't look at Lexington Law, don't look at all the shiny objects on the internet, these guys are going to do you right, then they convert much better and they're more dedicated to this process. And three, when I help my loan officer and my realtor and the client get that whole goal accomplished of getting finance, I do love what I do. So what we've done over the last 10 years or 11 or 12 in March, we've created a very good, not only follow-up system, but process and how we repair credit. So when you have your opportunities, right? You have somebody that wants to do a lease option, they want to do a rent to own, whatever it is, somebody that wants you to take a risk with them. The first thing we want to do is identify what's going on with them. So one of the things that we talk to our clients with before we even look at their credit is, number one, what's your goal, right? I mean, if you're trying to get converted into a mortgage in 60 days, probably not going to happen. Yeah. Have 6 months to a year, great. Now we're talking, we have a serious amount of time to get things done, and we're not putting ourselves in a bind. The second thing I want to know is, Do you feel like you're beyond whatever economic event that happened to you? What happened with your credit? And are you on track? Because somebody that's currently in financial stress, it's going to go ahead and show itself on its credit report. Meaning when they're maxed out on their credit cards, they were late on their car last month. They've got charge-offs that were just charged off in the last 6 months, or new collections. They're not beyond it. They're currently in that spin cycle, and they're going to need consumer credit counseling or bankruptcy, or at least a consult for one of those types of programs. So we'll identify that. So as you're sending people over, we're happy to look at them. But if we don't think that they're going to fit our program, or they're not going to actually get their end goal met, then I don't want their business. One, I don't want you getting a complaint. Two, I don't want to get a complaint. And three, we're regulated pretty heavily as a credit service organization, not only by the state of Ohio, but also by the federal government. So I'm not sure if everybody on this call knows who the CFPB is, but that's the Consumer Financial Protection Bureau. They were actually approved as an organization to oversee Dodd-Frank when it was enacted, but now basically look over and watch most financial service industries. So they have their own set of very strict laws on how I'm able to do business. So the last thing I want is someone to go ring their doorbell and say, hey, I got a problem with these guys. So we're very careful and selective in who we enroll. But when we do get them enrolled, what's nice is this. They get a dedicated case manager. So the case manager that they're talking to has no less than 15 years of consumer credit experience. I mean, one has come from Bank of America. After 13 years, she's been with me almost 8 years. Another one was an underwriter for auto finance industry for a decade before she came to me. Has been with me for 7 years. They're both trained by my partner on FCRA and FDCPA law. So, whenever somebody asks, what's so good about them, I just basically say that they're super smart when it comes to this stuff. So everybody that works with us gets a dedicated case manager that's going to work with them from cradle to grave and keep you informed, right? So credit repair is not just generic dispute letters. We're very clear to make sure that your clients understand that this is a team sport. You can't pay me to repair your credit so that you can go get your loan. You can pay me to work to clean up as much as I can on your credit report. You can pay me to consult you on the accounts that are validated so that we can settle them properly, whether it's settling for less than full balance because you're on a budget, or, hey, let's pay it in full and see if we can get a deletion letter that way, okay? But the other side of this tale is they've got to be willing to get in shape. They've got to do the push-ups, meaning they have to have a healthy mix of positive credit. So we suggest to them where they can get their secured credit cards. We suggest to them where they can get a couple non-traditional trade lines that post as revolving accounts, which really are helpful. We talk about authorized user accounts, and we make sure they know specifically if they don't follow through on this action plan, they're not going to get their goal accomplished. I can clean up 30 collections off of someone's credit report today, and if they don't open new accounts or pay down their high limit balances, then their scores are not going to improve. So we're clear with that from day one, that our job is the information on your credit report. Your job is to work your scores up. So it is a bit of a departure from what a lot of companies will do. If you go to the big box places like Lexington Law, sure, they'll tell you, here, we suggest that you do this, and we're going to get to work on improving your credit right now. They don't care what's bad on your credit report. They'll take anybody, literally. I had, just for an example, one of our employees said, I'm going to sign up with them. I want to see what this is like. She had one 30-day late payment on a student loan that was 3 years old. I'm telling everybody on this call, that's no need for credit repair. But man, did they work to get her credit card from her. We're going to work to get that laid off. It's absolutely holding your scores down. We need to work to get that off your credit report. Let's get started right now. It's only $89 and $99 a month. But she signed up, and they let her. With somebody like us, you refer me somebody like that, we're going to say, listen, you don't need credit repair. Here's what you need to do. And we're going to follow up and let everybody know what our result was from that review. But as far as the process and kind of how we repair credit, everybody that signs up with us, it starts with a discovery call. So once we get that credit report in and reviewed and say, yeah, you're a good candidate, let's rock and roll, they sign their disclosures. We don't take any money in advance, by the way. So they don't pay us to look at their credit report, for the follow-up, for the enrollment. Even after they've been enrolled and done their disclosures, it's not until they have met with their case manager over the phone and are comfortable before we capture the first payment. Okay. So on that call, on that discovery call, we're scrubbing their technical identifiers, names, addresses, employment, phone numbers, all that. But as we move into the negative accounts, we're asking them questions about what they know. But our case managers are also identifying anything technically that we can challenge on it. So the more we can bolster the case to get it deleted, the better our chances are getting off the report. Once we finish those accounts, we then stop and say, listen, here's your game plan. This is your homework. Without this action plan being executed, you're not going to be happy with the results. So we explain to them what that is, and then answer the questions, finish the call, capture the first payment. So from there, we do have to go to the bureau. So if anybody here has not known or has never worked on their credit before, the Fair Credit Reporting Act requires a 30-day time period that the bureaus and the furnishers, these collection companies and creditors, have to reply to these inquiries. So that's why credit repair takes time. It's not like we're trying to drag it out. It's just by law, they have 30 days plus 5 days processing on each side. So we run in a 40-day round. But halfway through, we reach out to the client and say, hey, don't forget to send responses you're getting from the consumer reporting agencies. If you have any questions, please let us know. And then at 40 days, we help them, if they're not already enrolled, get into a third-party credit monitoring service so we can do a report card. These are really important because on the report card, and I can show you a sample here, they have 4 dynamics on that. They have the current scores, where they were derived from, knowing that they're not FICO scores. This is not your mortgage score, but it's going to be something that's similar, so we can't compare it exactly. The section 2 on the report card has everything that we've corrected and deleted, so we're kept honest, right? So they know, what are we doing for our money? How far have we gotten on the credit report? Section 3 on the report card is going to have a complete utilization workup, meaning all of their accounts that are open and positive. What are the limits? What are the balances? Have they paid it on time that month? So now we know, are they doing their job? And then the final section is going to have any new collections or any resold or re-aged collections notified there. So in a snapshot, as a property manager, as a loan officer, as a realtor, whatever it is, you can look at that and go, are we making progress? And who's doing their job, who's not? Because hopefully, listen, a couple rounds in, we've got their scores up, they're ready to finance, or at least they're prepared to, and we can help maintain that. But we don't just mill letters back and forth with the bureaus. We basically stack the deck as if Bob was going to sue ultimately. But instead of suing them, we end up filing a complaint at the CFPB for them. Because if you haven't written this, if you haven't been to consumerfinance.gov, you might want to check it out, or at least have it so you know about it. It's like the BBB on steroids. It's the CFPB website. You can actually complain about a finance company, give them documentation. Not only can they inquire about it, but if they think that they're in violation, they can take enforcement action against the company. So it really is kind of a big shot and to be able to help the consumers. Now, you can't just go and complain to them right away. So that's why we try multiple steps first. Yeah. Exhaust our options. So first we'll go to the bureaus. Second thing we'll do is go to the furnishers and make the consumer sign and forward some letters. We may send a demand letter. So, and we clarify with everybody, we're not your attorney. I don't represent you, right?
Right.
But the attorney for CRR can send these demand letters on behalf of the company for our clients. And we make them acknowledge they understand that.
Yeah,
It's pretty hefty.
That makes a big difference when you have an attorney sending a letter to a company and they're like, "Oh crap."
Well, and that's true. And we're pointing out specific places where they may be in violation of whatever law that we're trying to enforce. It's compared to, like, if you were repairing your credit yourself or another consumer were doing it, it's the angry consumer letter. So instead of pounding my fist saying, I'm going to sue you guys and I know you that my rights are being violated, this is a very subdued letter that says, hey, based on the Fair Credit Reporting Act, Section 610, you have failed to reply responsibly and properly to this dispute. Please forward this information to our office, have this removed from their credit report, or have your legal department call us. Sincerely.
Yeah.
So that's step 3. Worst case scenario, if we can't get an answer, then we'll go back to the bureaus and find out how they got one in 30 days, but we can't in 90. Last case is now we stack all this deck and I'm filing the complaint. So they're getting full service for what they're investing with us. That's not just, we're not taking their money for no reason. And, when people say, well, why am I paying you monthly? And the answer to that is I have to make money. I have to stay in business. I try to make it affordable for all of our clients, but I can't charge you everything up front and say it's $800. First of all, it's against the law to charge in advance for anything. So I can't charge for the months that are subsequent.
Yeah.
Two, we don't work on everybody for a full 6 months all the time. Some people are done in 4 or 5 months or 3 months. So why pay me in full when you might only have to pay 2, 3, 4 recurring payments?
Right.
So, if you look at us online and you do a reputation check on us after the call or anytime, you Google my name or Google credit repair resources, there's maybe out of all their testimonials on my site and on Google and Yelp, there's maybe a handful of 3 complaints in the last 12 years. I've had, I think, 2 or 3 complaints at the BBB in the last 12 years total. All of them were resolved. All of them were, they're not doing their job. Everybody gets mad because my scores aren't improving. Okay. And that's typically the reason that people complain. But if you go to my website, you'll see that intentionally there's nowhere in my website that just says credit and score next to each other. I just don't put it. Because promised results are the key thing that gets you in trouble with the government, right? Promising to improve your credit score, promising the time that it's going to take to cure, promising that an account's going to be deleted off the credit report. Those are all deceptive practices. So we're very careful to just, not assimilate ourselves with that type of marketing to protect everybody on this call and ourselves and the consumer themselves. They have to want this more than we do. So everybody here, if you have people that want to rent to own, they can be tire kickers all they want, but until they actually put some skin in the game and show that they're committed to this process, I put in a lot of checks and balances to make sure that we know that coming in.
Yeah, and you made a couple good points that I wanted to touch on, Chad, that you were discussing so far. There are still people even just doing it out of their house. Credit repair specialist, and they're collecting $800, $900 up front. And that's what I was going to ask you. I thought that was illegal, but it's still happening. So you got to be careful who you're dealing with. And then on the flip side, you've got someone like you mentioned, Lexington Law, which is probably the most well-known. And I don't know if this is 100% accurate or not, but I have heard that them or other companies offer a much lower monthly rate, but they'll only dispute one item at a time.
Literally. And that's so, now I have colleagues in the industry. I have a lot of friends and colleagues that are smaller than me. I have ones that are bigger than me, but I've people that know contacts at Lexington Law and know about progression marketing. So I'll give you a quick rundown on Lexington Law. In 1996, John C. Heath, an attorney like my partner, started this company and beat the wave. I mean, he was on the head of the crest and bought the internet basically to this day. They were bought, I think, about 5 or 6 years ago, or at least 50% majority stake by a company called Progression Marketing. Progression is a massive marketing firm that has taken their process and said, how do we maximize the dollars? And they've always been this way. So they have a goal of an 18 to 24 month subscription rate. Their goal is to keep people in their system for a year and a half to 2 years.
Wow.
Whether they're paying them $49, $59, $69, $109, they don't care, because the more subscription they have, the better. And listen, I'm in business to make money as well.
Yeah.
I just chose to not go that route because I didn't want to deal with the consumer complaints that come with it. But in order for them to keep a consumer in that subscription that long, they only dispute, I think, 1, 2, or 3 items at a time, depending on the level that you enroll with them. And they'll tell you when you sign up that we can only do that. We're not allowed to do any more than that as required by the credit reporting agencies, which is complete farce. We actually can, as long as you're asking legitimate questions about the accounts, they cannot be deemed frivolous. Okay. So that's Lexington. And that's really when you go to them, if you have 2 years and about $1,500 over that time period, then they will get the job done eventually. It's not that they don't know what they're doing. They've obviously got direct connections with all 3 consumer reporting agencies. So they communicate directly with them, but that doesn't mean it gets done any faster. That's not the so the big monsters out there, that when you're seeing these low monthly fees or these massive marketing campaigns, it's not the same product. Now the onesie twosie things, when you talk to someone, hey, my buddy does credit repair, or I'm working with my realtor's friend, they do. A couple things that you'll want to find out is, okay, that's fine. What's their process? What makes them an expert? What's their background that makes them good at credit repair? And how do they repair credit? What is their chronology of investigation for know how they're doing this? And are they licensed, bonded, and insured? So I'm protected. Everybody's protected if something happens. Nobody wants to get a complaint filed against them because something was disputed, right? And then all of a sudden they get a summons to appear in court. And the next thing you know, they got a default judgment. And the next thing you know, their wages are being garnished because the credit repair company disputed a $12,000 charge off that was within compliance and put this client in harm's way.
Yeah.
All of us then have a problem. So there's things to know about when you're dealing with these, I call them the basement shops, even the big box. So that's a little bit of feedback on those. I hope that helps.
Yeah. Speaking of feedback, hey, Sean Brady, will you mute yourself? We hear your saying.
Sorry, thought I was muted.
That's all right.
I mean,
It said talk to.
we love that you're doing the dishes, and so does your wife. So, what should we know about? Can you talk about credit breaches some? What should we know about that? And because actually, one of our coaching students just had his entire identity stolen, and they opened credit cards and they actually bought cars. Like he's a mess right now.
So identity theft, breaches, and all that right now, it's an ongoing problem. It's not going away. It's interesting. I do CE courses for realtors, and every time I teach one, I ask in the beginning of the class, who's monitoring their credit? And like a handful of people raise their hand. By the way, who on this call is monitoring their credit on a weekly or monthly basis? If you're not, I'm not joking. You're literally putting yourself at risk every day. Yeah. Here's the deal. When you look at breaches, I just did a quick video on this with another partner. You've got 500 million with Marriott. Who knows how many of those are international versus local, stateside. You have 150 with Equifax. You have a Home Depot breach for 150 million. You've got this little company called Exactus out of Florida that had 300 million records taken from them. Okay. In the last few years alone, there's over 1 billion records that have been taken. So if anybody feels like, well, my stuff hasn't been compromised, you're wrong. And I can't say definitively, but it's quite likely that everybody on this call, your information is being held by somebody you don't want to have it. And they do it. They work differently than they did 10 years ago. So 10 years ago, it was smash and grabs, right? Capital One employee loses their laptop and has 200,000 social security numbers stolen. Oh my God, that's horrible. Okay. And then people would see that you're getting charges at Target for $200 or $500. And all of a sudden someone just bought a big screen TV on my credit card or whatever it is, and how they were using the accounts. Today, it's not like that. Today, it's $1.09 from British BP. It's GetGo for $2.17. They'll mask the account and where the money is being taken from, so it looks as if, and they'll just take $1 at a time. So if you look at, let's say, everybody in the country, if your information has been taken, and they take $1 a day from 50 for 25% of those people, right? 200 million records. That's $50 million a day that these hackers are potentially aggregating, just if they're taking $1 a day. Mm-hmm. So it's a big business, and it's not just happening stateside. It's happening, they're hacking us from all over the world. These are people that know that they're not governed by U.S. law, so they don't care. So we really recommend that everybody monitor their credit, and more importantly, monitor your accounts, your checking and savings, anywhere that you have the access for money to be taken from, anything that is connected to a PayPal, a Venmo, Zelle. Most of them are secure. Like U.S. Bank, I bank with them for many years now. I have Barclay Bank cards. Anytime, like something like I've done a couple of things where I've paid out of state, I buy something out of state, I get a text. Did you just spend $370 at Nordstrom or whatever it is? and I respond now. So they're good at most of that. It's these really small balance transactions that they may not catch. So really tell you and your clients to monitor your accounts regularly and definitely monitor your credit at least once a month. Like Credit Karma is great because you can update it every week. So you can see any new activities happen. A lot of the banks will offer some sort of a monitoring service. There's some sort of identity theft protection. If they offer it, take it. You just can't be too safe these days. And that's really what I can tell you about that. It's not over. They're going to continue to hack and take our stuff.
Yeah. Yep. You had mentioned to me before, and I don't even know what this is. What is the UltraFICO score?
Right. So, let's call it consumer advocates and various members of the government have always been working to try and provide more access to credit for people with young or thin files. So people that, are just out of college or people that have never had credit before.
Yeah.
Under the FICO, especially the mortgage credit scoring model, if you don't have accounts, you don't have a credit score.
Right.
If you just add a credit card for the FICO Classic model, it takes 6 months for that to season and start reporting a score. And even on the other, like the newer models that are used by the auto industry, the credit card industry, student loan industry, they still sometimes with younger thin files don't really show the true picture of a consumer. So UltraFICO is basically their answer to everybody wanting utility statements, utility bills being reported, rent being reported.
Oh, yeah.
These ancillary payments being reported to the consumer reporting agencies. Instead of that, this UltraFICO is allowing consumers to attach their savings, checking, and retirement accounts to Experian. Currently, Experian is the only one that's participating.
Okay.
So they'll take into account your pay history on all of your, on your payments. They'll look at the frequency of deposits that you're making, the frequency of withdrawals, the amount of withdrawals, basically your overall activity with your finances aside from your credit report, and they are going to start incorporating that into your credit score. So it's not for, listen, there's some requirements. People that have bad credit, it's not going to help them, especially if they've had any derogatories, any like missed payments or anything, checks that have been bounced, any derogatory banking. You can't have any of that for 3 months or longer. So it's really not for that. So there are some requirements that you have to meet to be able to opt into that program. And right now it's in beta. So there's some lenders that are testing it currently. And if it goes well, by the summer, you'll see it roll out to all 3 bureaus and be a lot bigger. And actually, I pulled up this. This is the web page. Can you guys see the page?
Yes. Yep.
So this is it. The score you build, and in here, there's the basic behind out of it. Show that the average savings without a negative balance is past 3 months. See an increase in their FICO score with the UltraFICO score. So you can get more information on it here. So here they're saying more people can score with UltraFICO score. So there's 15 million consumers right now, and really, as all of especially in the mortgage industry, the refinance boom has all but come and gone, right? I mean, so the mortgage market thrives on people refinancing their houses. Right now, there's, they say there's about 6 million Americans that if they had a higher credit score because of without their younger thin file, they'd be able to qualify for a mortgage. So you have, trying to keep the economy moving. And then you have also Fannie and Freddie Mac also trying to make sure you're continuing to buy mortgages that are solid. This is starting to get a little bit of traction now. To kind of go off of the UltraFICO score, our industry, ultimately your income is predicated on the fact that a loan officer closes on your buyer, right? Or your rent to own.
Right.
Right. So It's very specific to Fannie and Freddie loans. So they use a scoring model called FICO Classic. FICO Classic's been in place since 2004. And no other credit scoring model is even allowed to be delivered to Fannie or Freddie. So there's very different behaviors in the scoring model for that than there is anywhere else. Also, Fannie and Freddie are currently testing newer scoring models that would incorporate virtual FICO. FICO 8, FICO 9. Okay, these are the newer models that are out there. Will incorporate this, but there's no guarantee that they're going to sign off on this. It's called the Competition Credit Act, was actually part of that bigger bill that was passed this summer for regulatory relief. Federal Store Competition Act is what it is. And basically, it forced Fannie and Freddie to start testing new models. Otherwise, they would not have. Yeah, be happy with what it is. Now, a couple things about that. When people come to me or they go to you and say, well, I'll just pay off all my collection, right? And then I'll get my scores will improve. Based on we're in the consumer world and the auto industry and most other industries, that's true. When you pay off a collection or a bad debt, it's what they call bypassed by the scoring models. Under the FICO Classic model, when they just go pay off all their credit cards or their collections rather, it actually lowers their credit scores. And it's the converse from what any consumer would think. Like, hey, I just paid off all my debts. Can I have my score back, please? Right? I mean, that's logical to them. But if you're a bank and Chad just paid off $5,000 in collections, what does that mean? It doesn't make me a better risk. I'm not a 700 borrower because I paid off a bunch of old bad debt.
Right.
That's actually increasing my risk temporarily. It's saying Chad's trying to buy something. Why would he go and pay off all these debts? So once you pay off those debts, your scores may drop significantly initially, and they'll let them come back organically with your responsible use of credit. So that's why Fannie and Freddie have fought vehemently to keep this model, because all the newer models, once you pay that stuff off, it looks like it's never been there before. So they have to change their whole underwriting guidelines, their whole book, because then it won't be based on score. It'll be based on the accounts that are still posting on the accounts. So it may be paid collections half the season for 12 months, something like that. If they do adopt a new score. So it's a huge deal for them.
Yeah. So that new UltraFICO is not such a good thing for a bad credit person, but someone with no credit is more what that's based for.
Yeah, it's for little young thin files, or let's say somebody, I think eventually you're going for a large commercial loans, things like that. Mm-hmm. Bigger, huge money, acquisition. That's where it might play too. And it's so in its like infant stages right now. Like I said, Experian's the only one that currently is participating and hasn't even rolled out to the other two bureaus yet.
Awesome. Cool. Or is that basically everything that's happening like right now with the government and credit reporting?
Well, interestingly enough, once Nancy Pelosi took their seat as the Speaker of the House, they made Maxine Waters, she's going to take the chair of the Financial Services Committee. I don't know if anybody here on the call is familiar with Maxine Waters, but Maxine Waters is a huge, massive consumer advocate and bank nemesis. So she basically feels that everybody deserves to get credit, that collections, once they're paid, shouldn't be on the credit report for more than 4 months. They should be removed in 120 days. She feels that basically that medical debt should have absolutely no impact on a credit score. There's a lot of things that she wants to see happen in credit reporting and overhauling that system that the banks are absolutely against. See, it's kind of like this, who's right, who's wrong. Everybody deserves, listen, I'm not a millennial. I'm a Gen Xer, so I just dated myself. But I do not believe everybody gets a participation prize. Right. I believe that you have to earn the right. Credit is not a rite of passage in America. It's something that should be earned. And unfortunately, you have certain parties that say, you know what? Just because they're a 520 credit score doesn't mean they shouldn't have a house.
Right.
It absolutely means they shouldn't have a house in most opinion, especially someone that's lending out that money. So, I'll be posting up, if you follow me on LinkedIn or Instagram, I'll be posting up more information as it comes down. But I just got a news flash that she's absolutely taken the gavel of the Financial Services Committee, and you should see a lot of action this year on Capitol Hill when it comes to credit reporting.
Awesome.
It's interesting.
So I know your website is like very robust, and your system for tracking and monitoring and you help so many people with raising your scores, but people also need to understand that the client or the
Sean, you're unmuted again, buddy. I don't know what. There you go.
there, now he's muted. Okay. So the client or the tenant buyer still has to do work. Like, I mean, you can send letters out and dispute stuff, but a lot of times people's scores are low because their balances are too high, or they have to pay stuff down or pay a collection. Can you give us any insight on your process and kind of how does this scoring model, just a 30,000 foot view, how the model
See, balance to limit ratio, in a healthy mix of credit. Obviously, at least having one installment loan. If they don't have one, that always helps. It's obviously not going to be a house, but it could be even a signature loan. That shows that they can make monthly payments to complete and satisfy a debt. But what they really like to see is utilization. Can you manage revolving credit? Are you responsible enough to borrow money, pay it back in a timely fashion, and not keep high balances and pay a lot of interest? So when it comes to credit cards, people ask, Chad, how many credit cards should I have? And really the answer to every credit question is it depends. So the key is this: you're scored on your credit cards not only on an individual basis, on the open date, how long you've had it, meaning the seasoning, on how much is available to you, how much do you currently owe on that account, and how much have you owed historically over a 24-month period, and then also on your pay history. Okay, so you're scored in aggregate. So once they calculate all those asked and answered questions about your revolving accounts, they add up what you have in total available credit and what you owe in total on your available credit. So it's 40% is what is necessary in order to start seeing healthy improvement in the credit score. But actually, FICO, I have a colleague that I do I do an event every year called the Credit Expert Summit. He actually worked for FICO for 7 years. So he emailed them and asked his FICO rep and said, hey, what's the proper or ideal maximum, or what is the best possible utilization for credit cards? And they came back and literally just wrote 1%. And that was the response, meaning you just want to have enough to trigger activity. So here's a kind of a tip. Credit cards, like I have an American Express card. I've had it since 1993. I pay the $55 every year, okay, so that I can have that anchor date of 93 being a seasoned account. I haven't used it in probably 15 years. But the only time during the year that actually shows activity is when that $55 amount owed for the subscription reports to the consumer reporting agencies. And what that means is, on a credit report, if you ever looked at a residential mortgage credit report, it has something called the last date of activity, where it'll say DLA, or last active date. That's called an impact date. Okay, so that means if I don't use that credit card for 2 years and there's no balance on it, it's going to show the last active date was 2 years ago. It's not being pulled into the algorithms as tightly as something that was used last month. So by using just 1% of what's available on the credit card, I'm triggering activity on that card every month. Therefore, it's being put into that calculation as best as possible, if that makes sense.
So, and then I have another add on to that, and you answer it or just give your input. So I've heard of people that have credit cards that have this not astronomical limit, but a higher limit. And then they use the majority of that and then they pay it off. But then the credit card company lowers the limit to then it's consistently maxed out, even though they're paying down the debt. They're lowering the credit limit as they pay it down. So I'm assuming that by doing the 1% or even 5% of what's available, then that will combat that as happening.
Yeah, that's all based on account maintenance. So they do, credit card companies will do account maintenance regularly. And during the meltdown, they were doing it almost daily and setting alerts. So when they see that you've maxed out a credit card, and they may look at they have the right to look at the rest of your credit report. And if they see you using any of your other accounts like that, and maybe even maintaining a higher balance, even though you're paying their credit card off, it's a yellow flag. Something's wrong. Chad's maxing out cards. He's not, and now if you're maxing out your card and paying it off in full every month, that should not happen.
Right.
Because there's, not to muddy the waters on this call today, but there's another new technology that's called trended data. You may have heard of this. So the credit card companies, the credit reporting agencies previously weren't able to see what your pay history looked like. They just were able to see what the balance was on the statement date. Okay. Now the credit reporting agencies can see how much you paid on that card each month. So if you're somebody that charges $5,000 and pays off $5,000 every month before the statement date, okay, you're notified or classified as a transactor. Makes sense, right? I use my card, I pay it off. I'm a transactor versus somebody that charges it up to $5,000, then pays down $500, then pays it low, charges it up, pays it down $500, pays it down $500. The revolvers inherently are going to be a higher risk. So if they're seeing that all of your activities like that, that's why they're likely going to lower your available limit, because they see that's like their window period to kind of cut you off a little bit.
Yeah. Okay. That makes sense. I didn't realize that they could now see that, obviously. So, all right.
Yeah.
That's interesting.
Yeah.
All right. Anybody else? Oh, I was going to say, anybody have any questions?
Well, Chad was going to show us a little bit of his system too.
Oh, yeah.
Yeah. So after the call, what I'm going to like to do is set you all up with your own kind of referral partner link so that you'll be able to send opportunities to us. And if you have somebody for us to look at. So your form looks similar to this. You have it, you bookmark it to whatever browser that you want to use, right? And then give us their first name, their last name, email, phone they're going to answer. You have a spot where you can give us a note. Client wants to rent to own in 12 months, currently have 550 score and interested in speaking with you.
Okay.
You click, if they gave you a report to review, or I don't know if you guys pull screening reports, you can actually click and you can upload the report directly from your desktop securely into our system. So once you click go, what will happen is this. Say here, I'm going to set one up for Jay. So I'm going to call Johnny wants a loan, right? His email is noemail@crr760.com. That's no big deal. Okay, so I'm going to assign myself as the salesperson. I'm going to put Jay as you'll automatically get tagged as that partner. I'm going to put yes. I'll upload it right now. Jay, do you have like a secondary email that I can add this to, so you can see the emails that you get as a consumer?
Yeah. Use JAYADKINS Ohio @yahoo.com.
And then what's a good phone number? What's your phone number?
740-403-6033.
Okay, so you'll get to see the action set that happens behind there. So I will put action day today. I'll put Friday. Set it for Cindy. Please review. All right. So I'm clicking now. You'll click go. As soon as you click go, you're going to get a response email that says, hey, thanks for the referral. We're going to contact them right away. Jay, in about 25, 30 seconds, you should get a text that says, hey, we've got your report. We're reviewing it now. If you have any questions, let me know. If I indicate that you have a report or didn't have a report at all, it'll send you a link in that text in your email where you can go get a credit report with a free trial for a week. So if they didn't pull credit, I've got a relationship with Identity IQ that allows them to have a free trial for 7 days so we can see if we can help them or not. If we don't think that they're a fit, they can cancel the account. If we do, then they're going to go ahead and we're going to ask them to stay enrolled.
That's awesome.
So if I go over here now and I go back into my system and I bring up your contact record, I'm going to be able to see that you just had Johnny wants a loan added to the system, right? So I can pull up his contact record. And right now there's action sets that are happening behind the scenes. So let's see if an email has gotten yet. Nope. So you should have gotten a text by now or any second now.
Yeah. Yep.
You get it?
Well, Bonnie can verify that. She's on the call. She's got my office. That's my office line, but it is a cell phone, so it'll receive a text.
Yeah.
Got it. So she's going to get a text that says, here we go, post.
She says no text yet.
Hang on. I'm forcing it out. So here, I'm forcing out your response. These are all based on timers, just how it is in our sequences.
Yeah. And the other thing I like, Chad, about your system is every time there's an update on a client, we're getting an email or a text, and so is the client. And that's really powerful when you're working with a tenant buyer because, if you're just sending them to a lender and they're like, well, first of all, most lenders they'll just say yes or no. We'll do the loan or we won't. They won't even give you any credit advice,
Right.
Most of them. But the ones who do will say, okay, do this, this, and this, and this, and then you should be good for a loan. And then they never hear from them again. And you get the tenant buyer in there and
They don't ever do anything to improve their credit because it's in their lap.
Yeah,
It's only their do it.
it's 3 months away from them, supposing to be executing on their deal. And you're like, hey, how's the credit thing going? Oh, I have no idea.
We call ourselves kitten herders.
Right. That's
Right.
exactly right.
And, that's where I really kind of, from the very beginning, said there needs to be that conduit, and everybody needs to be kept honest. Listen, if I'm not doing my job, anybody that you send to us, if 90 days goes by and I can't show meaningful improvement in their credit profile, not their scores, that's their job,
Right.
give them their money back. So
Yeah.
performance warranty. So I need to be kept honest. They need to be kept honest because the first couple of years in business, especially working with property managers or owners, they were like, what's going on? Or the client would call and say, my scores aren't improving. And, what you guys suck. And I want my money back. And we'd have to go in and drill into each file, right? So that's why we created the report cards. And while that's setting up those action sets, I'll bring up a sample report cards so you can see what they look like.
Yeah, and I got your email about Johnny. He's in review.
Awesome. Let me go to sample.
So yeah, that I think one of the huge benefits is your reports going out monthly. They're seeing it and we're seeing it. So you can, it's keeping it in the front of their mind every month. Hey, I need to be working on my credit. I need to be working on my credit.
Right.
And I think the percentage of execution is probably raised. I'm pulling this from my own experience, but I would say the execution of the lease option is increased by 50%.
Yeah, and at least you'll know why it is or isn't. And when I ask is everybody on the call, and anytime you refer somebody to us, if you're getting alerts, like we'll send out an email, hey, we can't get a hold of Johnny, right? Johnny hasn't responded to us. We need his responses. We need to get into his monitoring service. We need permission to do so. We're going to ask for your help. And, saying, hey, that's not my problem. When they want to get to you, they'll get to you. Really doesn't help. The teams, it takes a village to get these deals done at the end of the day.
Yeah.
But, we'll alert you anytime that you need to. So you don't have to when the new system launches here in the new year, you'll be able to log in and see all the clients that we're managing for you. But you don't need that. We're setting up these automated alerts so that you can set it and forget it and just wait for us to follow up with you. So can you see Edmund's report card here?
Yep. Yes. And Bonnie did say that the text message
She got the text
too. So
Perfect. So then here's a report card. So it identifies here's where your sections are: scores, deleted, repaired items, open, active, positive, and new listed items on your credit report. There's the login to get into their software in our back office. And then you've got your Equifax scores, your updated ones. Lets them know that these are not your FICO scores, right? But they can access their FICO scores. So everybody on this call knows this is the only site on the internet that you can get your FICO mortgage scores. So Experian, even though they say that you can get FICO scores there, it's not mortgage model. This will give you just about every score you need there, but it's $60 a credit report. That's why we don't have our clients go there consistently. It's very pricey. So there's, corrected and deleted items. You can see that we got a bunch of student loans deleted. Here's a collection from online services. This was for Equifax. Here's experience deletions. Here's transfusions deletions. Section 3 on their open accounts. They've got a Cap One card with zero balance on it. Awesome, good stuff. And we may ask them to add another one, right? We want at least 2 revolving accounts. And then if anything new shows up here, there's a new reinserted item. 2 different accounts that were reinserted in the account are brand new. So there's your snapshot. You know what's happening with the consumer. You know how far we've come because you'll know what the incoming scores were. And that goes out at the exact same time that it does to the consumer. So, and it's an email. It's not an attachment. You don't have to download anything. It's all in the body of the email that you get. And that will help you, obviously, reach out to them. But that's really the best time to reach out and tap them on the shoulder. Either give them the attaboy or kind of help kick them in the rear so that they can start taking action. And then once I go ahead and you'll see here, so even as I change the stage, if I go here and I change the opportunity stage to free review complete, this sets up a whole new action set so that that everybody will know that the review is done. If they get enrolled, you get another email. Congratulations, your client's in your pipeline and they're active and they're going. So all the way through it, they really we don't overkill, but you definitely get notified as you make changes.
Hey everybody, it's Jay.
This is Annie.
We are so grateful for you joining us on our podcast and listening in and participating. We want to offer you this additional free bonus, and that is joining our Facebook group.
Yes, where we will have other individuals, not just us, but having conversations on all things real estate, and we would love to have you join us. So just click the link below and head on over and join our group.
Thanks, guys. We'll see you on the other side.